Open up our deck. And we'll get moving through. Now, if you have questions along the way, feel free to use the chat to drop your questions in the chat. And I'll pause as we're going through the presentation also to check if there are any questions or any comments as we're going along. All right, let's get started here. So I love this quote by Benjamin Franklin: an investment in knowledge pays the best interest. You should give yourself an applause for taking the time out of your day to upskill yourself. Getting smarter about how to leverage your financial statements, pouring that knowledge into yourself is truly the best investment that you can make in both you and in your business. So a little bit about me. I have a bachelor's from Cornell and an MBA from NYU. Prior to starting my company, I spent about 25 years in insurance and banking, and I am a self-proclaimed numbers geek. So the opportunity to do this session is actually quite thrilling to me. And then I told you a little bit about my company, Accelerate Consulting Experts. So as we're diving into financial statements, I wanted to start off with just a little bit of perspective, as you can see here on the slide. Financial statements, I'm not going to lie, they can be complicated. There are a lot of line items that are on there. There are a lot of numbers. There are lots of different categories. There are many different types of financial statements. It can be very overwhelming and it can be very complicated. But how to effectively use them does not have to be complicated. And so part of my, one of my goals today is to show you how you can leverage your financial statements in an easy way, zeroing in on key numbers that are in there, on key ratios that you want to look at so that you can most effectively use these tools. Because I'll tell you, I myself, I've sat through other financial statement trainings, and when they start doing all of these calculations and these ratios, and it can be a little bit overwhelming. But when you know what to zero in on, it's going to be very, very easy. So that's part of my goal in doing this with you today. So let's start off here. I'd love to hear a little bit from the audience. Where are you when it comes to financial statements? Are you the person on the left that's dancing through the fields and feeling happy and gleeful about it, or are you the person on the right who's maybe feeling a little bit stressed, saying, oh my gosh, I have to look at these numbers? What's your comfort with financial statements? And here we go. We got a poll that popped up. So if you just want to click on the poll and then submit your answer. How do you feel? 0, not so comfortable. 10, you're very comfortable. All right, get your answers in. Fantastic. All right, so I see we have a couple 3s out there, a couple 4s, and you tend to be kind of in that 5 to 6 range. All right. Good to know. Good to know. Let's continue then. And really at the end of this, I'm hoping that by the end of this that your numbers go up. So let's see as we go through. So as I mentioned, we're going to do as our learning objectives today 3 things. I'm going to demystify financial statements. We're going to take some time going through each of the different types of financial statements that are out there and going through what are some of the key aspects of it. Learning how you can use those financial statements then to analyze the financial health of your company and use it to make decisions. And then the third part, use those as financial statements to make decisions. So let's start off a little bit about why do financial statements matter? And we oftentimes look at financial statements and they'll say, "Oh, we'll tell you about the health of your company," but it isn't just about the health of your company. There are lots of different ways that you can leverage financial statements. For example, your financial statements can really help you with budgeting. As we start going into the different types of statements, you'll see how you can pre-populate those statements to then get an idea of what are your numbers going to look like at the end of the year, or what do you want them to look like, and be able to simulate those statements and then be able to budget against them and be able to trend and see how your company is performing. You can leverage the statements to help you with your pricing strategy. See, are you charging enough? Are you generating enough profit within your company? Or do you maybe need to adjust some of your pricing and come up with a new strategy? And then you see how it affects your bottom line. For your taxes, tax professionals love when your financial statements are in order, because then it makes it so much easier to prepare your taxes. And as you're monitoring your financial statements, it will also give you an indication maybe of what's going to happen with your taxes as well when it comes time to file. Investors. Investors want to see how your company is performing, and they want to know not just how many customers you have and what types of services you're providing, but they do want to take a look at the numbers. And so, an easy way and a uniform way that they can assess that is by looking at your financial statements. So, if you're thinking of pursuing an investor or seeking some type of investment, having your financial statements in order and knowing what they look like beforehand will better prepare you going into those discussions. Same thing if you're looking to go to the bank for a loan or for a line of credit, they want to assess and they want to see what's the likelihood that you're going to pay back that loan or that you're going to be able to afford that line of credit. And the financial statements are how they do that. And then lastly, we have your program participation. If you're pursuing things like certifying your business, maybe as a diverse home business, you will have to provide copies of like your financial statements with those type of certifications, maybe some government certifications or other types of opportunities that are out there. And so there could be various programs applying to participate in a program for professional development that's for business owners. They may want to take a look and see how's the health of your company. And so having your financial statements in order can help you in a variety of situations. So let's start off with what are the main types of financial statements that are out there. There are three key types of financial statements. The first one is called the profit and loss, or you'll also sometimes hear it called an income statement. So sometimes it's called a P&L or an income statement. The second one is the balance sheet. And then the last one is a cash flow statement, or maybe just cash flow. Each of these statements, they have their own unique numbers that they collect. I'm going to show you how some of these statements do talk to each other. So you see how there is a connection between the two, but they all have unique needs and a unique readout that they'll provide you. So let's start diving in. Let's start with the profit and loss statement. So the profit and loss statement is a statement that is going to show you how profitable your business is, just like it says, profit and loss. See, are you generating a profit or are you in the red and experiencing a loss? And then it will give you some high level details supporting those numbers as they're calculated. A profit and loss statement is something that should probably be prepared on a monthly, quarterly, and annual basis. And I'll give you some guidance with each of these statements. They're really not intended to be looked at on a daily basis. You could look at them on a daily basis, but really on a daily basis, it's about your general ledger, about those individual transactions that are going in that you may look at on a daily basis. But the profit and loss, looking at it as a business owner on a monthly, quarterly, and annual basis, you'll be able to see trending. You'll have enough data in there that it's really going to be meaningful and significant. So let's look at a sample P&L, monthly P&L, and start to see what are some of the numbers that are located in the P&L and what do they mean. So a profit and loss statement is separated into two main parts. The top part of your P&L is going to show your income or your revenue for the company. You're going to Most times see two lines underneath. You're going to see sales, which is your revenue. So how much did you sell to your customers every single month? How much they paid you, and you generated in sales. So it's not just it's not contracts that have been written. It's about payments that have come in, sales that you've realized. The second line under your income revenue is going to be the cost of goods sold. So how much did it cost you in order to generate that sale? If you are, like in my case, I have a consulting firm. So cost of goods sold is oftentimes very low to nothing. Versus if you're in the manufacturing field or if you are in construction, cost of goods sold is going to be a much higher number because there's product that is going into what you're selling. There are materials that are going into what you're selling. So there's a cost that you're incurring in order to generate that product and then sell it to your consumer. When you net the two numbers, that's where you end up with your gross profit. So as folks ask, oh, are you making a profit? First, we're taking a look at what are the sales that you're generating, and then how much is it costing you to generate those sales? This is the first place that we can take a look and use the P&L statement to start to get an idea of the health of our company. In the example that you have here on the screen, we can see that for this company in January, they netted out what they spent, what they generated in sales. That's what they spent that in generating and making that product. And they ended up with a profit of zero. But you can see in February that sales were a little bit higher and cost of goods was a little bit lower. And so therefore, in February, they turned over a gross profit of $7,000. But then in March, sales were again higher, but the cost of goods sold was also higher as well. And they ended up with a negative gross profit. Now, one of the other things that's important to look at and to keep in mind is timing. Timing is key here. So we may look at this and go, ooh, this company kind of seems to be a place they're not having steady growth, steady profit from month to month, but it may just be that maybe a large order was placed for product that was going into an item that was being manufactured, and it's charged on a quarterly basis. And so the March cost of goods sold may be high because that inventory was procured in March and then is going to be used throughout the months ahead. So I think it's always great with any of your statements then to also kind of look at your year to date to then see how are you trending year to date, not only what's happening month to month, but then see overall where is your company. So in the case of this example, this company is doing good. They turned over a gross profit of $4,000 year to date. We can't just look at each month and see what's happening, but we want to look at the holistic. The other part of our P&L that we see here are operating expenses. And so income and revenue on the top, and then operating expenses on the bottom. Your operating expenses are everything that is costing you in order to run your company. Not necessarily to produce your product. This is what it's costing you to run your company. So you see some of the common items that you'll find under your operating expenses will be things like marketing and advertising. Maybe it's to host your website, to produce promotional materials, to attend trade shows or conferences, but anything around marketing and advertising you'll find here. You also find your overhead costs, things like rent, utilities, anything around your facilities you can find here as part of your overhead cost. Payroll is another one. Payroll, though, is going to be for your employees that are not part of your your sales. So this may be things like some of your leadership, maybe like a CFO or a CMO or a CHRO, that you'll see your payroll in here. Taxes paid against that payroll, which we all have to pay those taxes. And it may be also business taxes that you're paying, that you may be doing a remittance on a monthly basis, prepaying ahead of time, or your state may have a quarterly tax that you have to pay, business tax, that will be captured here too. And then other things like travel. Travel maybe to go see your clients, or to go out to industry events or to do any type of research and development, but any travel that's incurred. What's nice about the operating expenses, the way that they're laid out here, and again, leveraging, taking a look at what's happening month to month, you can see how you're trending. Do you look at this and you go, oh my, we spent, and in this case, you may look and say, marketing and advertising was $200 in January, $200 in February, and then in March, it went up to $1,500. As a business owner, you're going to want to look for trends like that and then maybe start to question and ask, why was there that jump? What did we do that we incurred that expense? And make sure it wasn't that maybe something was coded incorrectly, or was misclassified, but you can start to then kind of get an idea of some of the numbers underneath, how they're looking at that higher level. So I'll also give you an idea of if you're saying, ooh, our expenses are high, maybe where should we look to shave back some of our expenses? This is a great place to look and to see where is where is there overhead that maybe we can scale back on. So you may say, you know what, times are tough. Maybe we need to eliminate travel. That would save us, in this case, $1,100. Or if your company's doing well, it's also going to show you where you can invest in. So you may say, marketing and advertising, we have a pretty low budget there. Maybe we should make more of an investment and do greater outreach to our clients and into the marketplace. So looking at these expenses will help you to both manage the health of your organization, but then also help you to make decisions about where you want to invest, and then also make sure that the numbers are looking correct. There's nothing that's very out of whack, nothing that looks that it's not trending like it should. So similarly, like with the income, it totaled out to your gross profit. With your expenses, there's nothing that's netted out of it. It just adds up all together and we come up with our total expenses. And then when we subtract our profit from our expenses, we come up with what's called our net income. And your net income is an important number because that's really not just the profit of your company. Profit is just from your sales and the cost to generate those sales. This is really at the bottom line. How is your company doing? Are you both generating profit, but also staying profitable as an overall as a company? Or are you spending more than you're totally bringing in? So in the case of this company, we can see that their gross profit, while their gross profit was $4,000 for the entire year, when you separate out the total expenses, the net income for this company is negative $5,900. So this company is not turning over an overall profit. They have a gross profit, but overall this company is not profitable. And that's okay. Sometimes this happens. Sometimes this happens for a variety of reasons. You may be making investments into your company and operating at a loss for a little bit. And you may say, yes, you know what? I know we have a big marketing push, or we're expanding the team and we're hiring more individuals. And so upfront, there may be this additional expense that's incurred. But you always want to think about, as a business owner, if you're incurring this additional expense, is it going to ultimately generate more revenue and then affect your bottom line, your net income, and keep your company in the black or in the red? So let me pause for a second about P&L. Is there any specific questions around profit and loss statement? Anything else, anything that you would like for me to re-explain again here or dive a little deeper on? All right, let's keep going then. And we could see here our nice little pop-up, you can increase your profit or reduce your expenses to affect your net income, which is also another key takeaway from all of this as we're thinking about how we impact our net income. Now, net income is an important number to remember because net income is the one number that is going to connect between your profit and loss statement and your balance sheet as we get into your balance sheet. I'm also going to show here a year-over-year P&L. So another way that you can also analyze and review your P&L. The example before, we did it looking at it month to month and then with a year-to-date at the end. So that gives you that vision, that view into what's happening month to month, and then what does that look like as an aggregate. You may want to take a look at how is your company doing this year to date versus last year, in which case then you'll want to change your view or request a view of your P&L year over year. So let's take a look when we now take a look at this year over year view. What are some of our observations that we're able to make? So we'll start off taking a look at our income and revenue. We see that year over year, sales are down, right? They've gone from 938,000 to 856. But we see that profit is up because while the cost of our sales went down, while our sales went down, our cost of goods sold, so our expenses into those sales, also went down, and it actually ended up increasing the profit for this organization. So let's not bring this up in this example because you don't want to think that just because sales are down that you're going to be less profitable. You can actually be more profitable when sales go down, as long as you're also managing down your cost of goods sold. When we take a look at our operating expenses, we see that marketing and advertising, that's significantly down year over year. That may tell us maybe we made a decision to not participate in certain activities, certain events, or optimize maybe some of our social media strategy or some of the materials that we're generating. But we also see travel is significantly up. This can tell us, has this travel been approved? Is this is this contributing to your bottom line? Your travel may be up because maybe you anticipated that sales were going to be down and you need to get out in front of your customers a little bit more. But this can also be a red flag to kind of tell you, why do we have all of this travel so much more than last year? And does it make sense that we have all of this travel if our sales are down for the year? So overall, expenses are up year over year when we calculate the two. But our most important number from our P&L, the net income, our net income is up year over year. So this is where it's so important to look at the individual line items, but the aggregate is really important and is what is ultimately going to tell the story of what's happening with the health of your company. So even though sales are down, net income year over year is up. And so this company is actually in a very healthy position and is positioned to hopefully further grow in the future. But even though sales are down, if an investor was looking at this, they wouldn't look and say, ooh, this is a scary situation. It would be a scary situation if sales were down and the net income was down as well. But in this case, the net income is up. And so we would applaud management in doing a great job here. So let's dive into our balance sheet next. So your balance sheet gives you a snapshot of your business's financial position at a moment in time. So unlike our P&L that we look at, we can trend month to month and look it out. Your balance sheet really is meant to be looked at as a moment in time. Balance sheets, my recommendation is that balance sheets be prepared annually or semi-annually. And we'll talk about what goes into changing the numbers and driving the numbers of a balance sheet. But this one doesn't have to be generated quite as frequently as your P&L should. So you can look at this really semi-annually or annually. So there are three key terms that we're going to look at on the balance sheet. And it's a little bit of a calculation. There are the assets, which is really what you own, what the company owns, liabilities, what you owe, and then equity, which is the amount of money invested by the shareholders. And your balance sheet is going to balance itself out, where your assets are going to equal your liabilities plus your equity. But let's dive into an example and see how this exactly works. So here we have a balance sheet. It's just broken in half. So it's the same balance sheet, just shown in the two columns. And here we're looking at a year-to-date balance sheet. We start off with, as we talked about, the first category, which are the current assets, what you own. Assets tend to be broken out into current assets and then fixed assets. Your current assets are things that are going to fluctuate may have a lot of fluctuation because there'll be a lot of transaction in it. Your fixed assets will tend to be larger items that you own that are not necessarily going to change in value. And so they will stay pretty, as it says, fixed in what they are as an asset. Your current assets are going to be, think about things like your checking account, your savings account. If you have any CDs, any business CDs or personal CDs, cash or some type of cash equivalent will most likely be found in your current assets. Your account receivables will also be found in your current assets. And this is a really big one. Not all companies, at least I've seen with the clients that I've worked with, are always tracking accounts receivable and putting it on the balance sheet. And I think that's a really important number to keep on here because you want to see, how much are you expecting to come in unrealized revenue, and that's your accounts receivable that's out there waiting for you. And then your fixed assets, like we talked about, are some of your bigger tag items, like equipment, maybe that you own, machinery, or it could be vehicles. It could be also some real estate. If you own your building, you'll find that under your fixed assets. There'll be a line item for depreciation. So you'll see how they'll depreciate over time. And then there could also be maybe some intangible assets that you also capture under your fixed assets. But we calculate all of our assets to come up with what is going to be just a big number of your total assets. So in the example of this company, they have a total assets. Actually, I did that calculation wrong. It should be 131 because 191 and 40 is not 131, my mistake. But in this case, we'll use 131. When we look on the right side now, we start to get into our liabilities. So again, our balance sheet is assets equal liabilities plus our shareholder equity. Liabilities are what you owe. So we have things like account payable. And I highly, highly, highly recommend if you have a bookkeeper or an accountant that is helping you to prepare your financial statements, make sure that they are adding your accounts receivable and your accounts payable to your balance sheet so that you have insight as to what you owe. And accounts payable can be what you're paying out to vendors that are supporting your organization. It could be payments that you have due for product that you've received for maybe some type of service. It could be like your accountant or a lawyer or consultants that you're bringing in, any invoices that you have not yet paid and that are outstanding that you owe on. You'll also capture things here like maybe credit card debt that you're incurring, any loans that your business has taken out, and then any taxes that are payable. And this maybe, you foresee that this is coming based, and your accountant will help you to calculate all of this. But this gives you an idea, liabilities of totally what does your company owe. The last number on your balance sheet that you're going to see is your shareholder equity. And your shareholder equity, this is where we find that connection to the P&L, because you can see the last item here is your net income. So is your company generating money or is it losing? Whether it's generating or losing, that line item is going to show up here on your balance sheet as part of the equity in the company, along with retained earnings, which carry over from your net income of the previous year, are captured then into your retained earnings of the next year, and any type of shareholder distribution, meaning any money that you've taken out of the company as a distribution is going to show up here in your shareholder equity. I would say, like, don't try and understand how you're going to calculate everything in your shareholder equity and everything that goes into there. It's complicated, but you can overall see what that number looks like to see, do you have positive equity? And the more important thing is to think about, do you have positive equity in the company, or is there negative equity in the company? And then overall, how are your assets balancing out against your liabilities and your shareholder equity? So in the case of this company, they're at 131,000. There is no, good number versus bad number. This is really about what your financial goals are for your organization. But again, you can look year over year to see, is the company overall growing year over year? Is it staying steady, or is it in a decline? And so those are healthy ways and helpful ways to be able to leverage your balance sheet. Balance sheets can also be used for your personal finances too. So if we go back and we look at the way the balance sheet is structured, you can use this for your business, putting in your current assets and your fixed assets. You can do this for your personal finances as well. So think about your current assets as an individual may include a checking account, a savings account, CDs, your 401k, any money market accounts. Your fixed assets will maybe include things like if you own a home, if you own your car, if you own a boat, if you have an art collection, any other type of asset that you have, you can calculate then what you have in your cash or your cash vehicles, as well as what you have in your fixed assets, to then see what are your total assets that you own as an individual. And then look at your liabilities. Your liabilities, do you owe anybody any money? Have you, I don't know, brought a contractor in to do some work on your home and you have some payments left to make on them? Those are your accounts payable. Do you have credit cards that you have an outstanding balance on? Do you have any personal loans? Any, your mortgage, your car loan? So you can use the same tool to then also calculate your personal assets and then net the two out to then see what is your overall net worth as an individual. And see year over year, are you growing in your net worth as an individual? Or maybe there are some tweaks. Downsize your car, pay off a little bit more of your loans, or use your credit cards a little bit less. But I think this is a great tool also that you can use to manage your personal finances as well. Oh, and here we go. I forgot I had this one in here. So you could say, as we were talking about 401k, stocks, house, car, boats, and all your liabilities. You won't have, if you use this for your personal finances, you won't have your shareholder equity. That's the one thing that comes off when you're looking at this for your personal finances. But another great tool that you can use, and you could do this simply. You could do this simply just like in an Excel sheet. Or if you wanted to get a little bit more sophisticated, you can use some online software to help you calculate all of this. And then, as we talked about before, you can then do a year over year comparison to then see how your overall financial health is looking. So I love the balance sheet. I'm a personal fan of it. All right. So before we go to cash flow, any questions on P&L or on the balance sheet before we continue moving forward? I'll just pause for a second. All right, we're coming into the home stretch of our financial statements. We have our cash flow statements. So our cash flow statement is going to track how money flows in and out of your business. A little different than what your P&L does and what your balance sheet does. When we take a look at a cash flow statement also has typically three components to it. The first is going to be operating activities. So these are the daily tasks that keep your business up and running, and the money that's coming in and out as part of those daily activities. Your cash flow is also going to show you about your investing activities, just as it says, from doing any buying or selling of your company assets. Those will be your investments. And then lastly, it will take a look at your financing activities, and that's any funding that you're receiving from investors or from loans or from any type of fundraising, maybe that you're doing to bring an infusion of capital into your company. So here is an example of a cash flow statement. Whoops. Here's an example of a cash flow statement. Again, breaking it into these three components: your cash flows from your operations, your cash flows from your investing, and your cash flows from your financing. These statements, depending on how many items you have in there, can be very short. They will not be quite as long as looking at at a balance sheet or looking at your P&L, but will give you a very clear snapshot of overall what's happening with the cash in your organization. You tend to do a cash flow statement at like the end of the year. So then you're able to see what was the beginning balance when you started when you started monitoring your cash flow, and then what's your end balance, and see what's the net change. So again, are you operating in a positive cash flow position, or are you operating in a negative cash flow position, which you'll probably feel that. But the numbers are going to confirm and to show you where and why maybe you're feeling some of the crunch in those numbers. So you'll be able to see, like in this case, cash flow from operations for this example, they have customer payments that are coming in to the tune of $1.6 million. That's great. But their operations is also costing them $1.5 million in payroll. But they're in a positive cash flow position for their operations, in a positive 100,000. So yes, good news. Then we take a look at cash flows from investments that they've made into the company. They may have purchased some equipment in this case. So their cash flow from investing is going to be in a negative position. It's not necessarily a bad thing because it is an investment into the organization, but at least we understand and we know where the money is going. And then lastly, in this example for financing, we have a loan that's out there and loan payments that are being made. And this can give an idea, and you can make a decision to say, you know what, cash has been tight. There's been a lot of cash that's been going out of out of the door. Do you maybe seek to refinance some of those loans and get it to a lower payment? Or if you're seeing that you're operating in a cash flow positive position, you may then say, you know what, we have some extra cash, so why don't we then further pay down some of those loans? But this shows you where the cash is coming in and going out within your organization, to then see what's your net change in your cash flow position and where exactly that's going. I find these, like, the cash flow statement is not a financial statement that everyone widely uses. If you have this type of movement of your cash within your company, then this will make sense for you. But if you're just starting off as a company, or you have limited products and services, or limited purchases that you're making, or investments that you have in the organization, then this statement you're not going to find it as useful, maybe as leveraging your P&L to see what's happening with your expenses and your income. Okay, so let me pause. So any questions about about the cash flow statement. Hopefully that made it pretty easy. All right, so you've had an opportunity now to walk through these three financial statements, kind of take a look at what are the key numbers that you need to look at, how you can use these statements to make decisions in your company, to assess the health, to get an idea of what's happening financially. How comfortable are you feeling now with financial statements? Your poll is up. I'd love to hear from you. 0, not so comfortable. 10, very more comfortable. Very comfortable. Get those answers in. Yay! You seem to be much more confident than you were before. This is great to see that we have our lowest at 5, and that many of you are now feeling that you're in that 7, 8, 7, 8, 9, 10 range. Maybe not 10s, but some 7, 8, 9s. I'm going to take that, and that's very positive. Thank you for participating in the polls. So to start to move into a little bit of our wrap up, your financial statements are really really important to help you make data driven decisions in your company, not to just necessarily go off of feel is important. Feel is important, and trusting your gut is important. But using your financial statements will help you to make some really educated decisions. You could see how you want to look at your statements, not in isolation, but holistically, to get an idea of what's happening in your company, what's going on with revenue, what's going on with expenses, what's going on with overall assets, your liabilities, with how the cash is moving throughout your company. The trends are really important to look at, rather than just a single snapshot, because you may make a change and that will have an impact in your financial statements. So taking a look at how overall you're trending, and again, toggling between maybe a monthly view of your P&L versus a year to date, or looking at year over year in some cases. Some final tips for your financial statement success. Review your financial statements frequently. I mean, I gave you some recommendations on looking at them on either a monthly basis or a semi-annual basis or an annual basis. But it's important that you are reviewing them, that you are taking a look at them, and that you're asking questions. I think that's the greatest thing that you can do. Whether you're preparing them yourself, or if you have somebody who's assisting you in preparing them, understanding how those numbers are generated, understanding why you're seeing your numbers trend the way that they do, or what's going into those numbers, is really key to increasing your knowledge about what's happening within your company and how that's impacting your bottom line. Leverage technology. You have the ability to generate or create your financial statements yourself by hand. I would not recommend that. But there are a lot of great tools that are out there, lots of different technology that will generate these financial statements for you. So you could use things like QuickBooks is a very common tool used amongst business owners. ADP also has another tool where you can input your numbers, and then it will come back and give you your financial statements. But leverage the technology that's out there so that it can do those calculations for you, and it makes it a lot easier for you, and makes it a lot quicker to generate. Stay current on your entries. So when we look at our financial statements are really driven by an aggregate of the individual entries that then come up with these overall numbers. So like, for example, when we look at our P&L and we're looking at revenue, your income is all of those invoices that have been paid and that have been entered into the system, and then show what your overall revenue is. Or when we look at the expenses, it's all of the bills that have been paid and those expenses have been incurred, and now they're hitting your P&L. It's important to stay on top of those entries. I recommend, as soon as expenses are realized or income is realized, that they're entered right away, rather than saying, well, I'll wait until the end of the month to enter everything into the system, or I'll wait until it's time to do taxes and now put everything into the system. No, really try and stay on top of that as much as possible. And if you don't like doing it, then delegate it to somebody else. Garbage in is garbage and is garbage out. So the information that you put into your systems, or that you're tracking and that feed into your financial statements, you want to make sure that it's just that it's accurate information, because if you're not putting good information into your system, then your financial statements are not going to be accurate, and then you won't be making what are truly informed decisions. And so I recommend for business owners that you kind of have your money team, as I call it here. And your money team would consist of a bookkeeper. That may be you. You may outsource that and have a bookkeeper for your organization, depending on how many transactions you have and how big you've grown. Having a tax accountant. A tax accountant is critical to be taking a look at your statements, helping you to digest them, to identify any trends, but then also to advise you from a tax perspective. I also recommend a financial advisor. A financial advisor can also help you to make investment decisions, or make other decisions about how to use your money, or move things within your, move any of your assets or liabilities within your company. So having that expert that can weigh in on that is really important, and also be able to advise between your personal and your business finances. And then lastly, a banker. Your banking relationship is super huge, and knowing your banker can also take a look at your financial statements, can also advise you of products maybe that you qualify for, or that may help you in managing the company. And it could be different things, like maybe a type of credit card, or it could be a line of credit, or different types of loans that are out there and what you qualify for, based on how your finances are looking. But having that relationship, and having somebody who knows you, who knows your company, and doesn't just know you for a transaction, but really is looking to support you in every step of the way, is really invaluable. And so I actually recommend, you may not be going into the branch all the time. Maybe put it on your calendar to just pop in once a quarter or twice a year, and request a dedicated banker, or find somebody who's there that you could build that relationship with. And you don't always have to go in with a transaction that's taking place. It may just be a catch up, but that's how you build that relationship, so that when you do need that transaction, when you do need that help, you're not then creating and building that relationship, but instead they're there to support you every step of the way. So that money dream team. And that concludes our session today on understanding financial statements. So I want to thank everybody for participating today, for carving the time out of your busy schedule to join us today on this seminar. Do you have any questions before we close out? Any questions you'd like to ask? And you can enter your questions into the chat.
Yeah, I do.
Diana, I saw in the chat that Shorts asked, could you give more examples of how looking at the balance sheet or cash flow statements can help with understanding the health of a business?
Sure, absolutely. That's a great question. Yeah, so let's go. I'm going to go back to our sample balance sheet over here. So let's look at our balance sheet here. So your balance sheet, if I was to answer the part of looking at the health of the business, what maybe an investor would look at, or if you were going to the bank or going to some other type of financial outlet, maybe to secure some financing, they are going to take a look at what are your current assets. So looking to see how financed is the organization, like how much cash do you have on hand. And it's a balance to be struck here, because you don't want to hold on to too much cash, but you also don't want to be cash starved. So your current assets will be something that anybody who's looking to make an investment or to make a loan into the organization, they're going to look to see, what do you have in terms of collateral, which will also then be part of your fixed assets if you're using your company assets for collateral. If you are a newly formed company, then the bank will want to take a look at your personal assets, which is another reason you can use the balance sheet for your personal finances as well. Then to see what you have in your collateral is, in the event that you default on the loan, how could the bank or the investor then maybe recoup what they've loaned to you? And so these two numbers will show some of that health. Again, there may be parts of the year that cash is lower, maybe as you're waiting for payments to come in or for large contracts to be completed, large projects to be done. And so this may change from time to time, but looking at your assets will indicate one portion of the health of the organization. The same thing with the liabilities. An investor or a banker would take a look to see how do your liabilities compare to your assets. Do you have like a lot of loans? And they may question why are you financing your organization as much? And sometimes there are very clear explanations. I was working with another business owner who landed a large contract with a corporation. And this corporation was unfortunately known for having like net 90 payment terms. And this company had to make payroll. They had to staff up in order to fulfill this corporate contract. Um, but they were going to have to make payroll and couldn't wait for payments to come in from the corporation, especially knowing that they tend to follow about net 90 payment terms. And so they took out a number of loans. And so this, and like with this company, their liabilities shot up. But it was explainable because they had taken on more contracts. And this is why, again, why we also want to look at and use our statements, our financial statements together, because the P&L would show that revenue went up significantly. And then you would see on the balance sheet maybe that there was an increase in liabilities, an increase in loans, because that was needed in order to service the additional revenue that came in. The trends are important because then we want to see, does the company continue to be over leveraged? And it's okay, sometimes you're over leveraged, and it's explainable because maybe you've taken on a large contract, but then over time, does that over leveraging subside and you become a little bit more balanced? So the health of your organization will also be looking at the liabilities. And then lastly, the shareholder equity. They want to see, is the business owner taking a lot of money out of the company? And they may question why. Or is the owner leaving money in the company to make additional investments going forward? These are great discussions to have with your accountant about what's best in your situation. Good question. Any other questions? We have 2 more minutes left. And then the cash flow statements. Good question, Schultz. So with your cash flow statement, again, with your cash flow statement too, and I'll pop over to that one, as we're looking to gauge the health of the organization. Your cash flow statement is more so as a roadmap to show where your cash is going. And so it's going to tie in with your P&L and with your balance sheet to just kind of show, are you making a heavy investment into your operations to see how your cash is moving in there. You may look in and be able to see. And again, it's relative to a point in time because it all depends on what's going on in your organization. But are you generating positive cash flow from your operation? If you're making an investment, if you're experiencing some growth, then this may be in the negative. But if your company your sales have shrunk, and you've not adjusted the rest of your expenses to go along with that, then you'll see this in the negative. So it will give you an indication of have you right-sized properly with what's happening in your organization, either for growth or for any contracting maybe that's happening. You'll also get an idea, and again, it's your investing and your financing. It'll all be part of your company's individual situation. They'll look to see, are you paying down, which is important. So in that case, then you do want to see that there is cash that's flowing out from that. But if you're bleeding too much money, your cash flow will show that. And then will also help to fuel some of your decisions about financing. Another great question. All right. So then with that, I just want to thank you for having me here today. It's been a pleasure to share with you about understanding financial statements. Thank you to USPAACC for having me here. If you have any additional questions after this session, my contact information is here. You'll also receive it electronically. Feel free to reach out to me. I'm here as a resource to help you. I want to see you succeed. And if there are ways that I can support you in better understanding and leveraging your financial statements, I'm happy to do so. Thank you.